Installed building products for IBP just reported, and they absolutely crushed consensus. They posted top-line revenue of $777.8 million.
Which is up 2.3% year over year.
Right, and it handily beats the street's estimate of roughly $743.3 million. And the bottom line was even better.
Oh, way better. Adjusted earnings per share came in at $2.91.
Completely obliterating the $2.55 estimate. That's, what, over a 14% beat?
Over 14%, yeah. And management didn't stop there. They didn't issue formal full-year revenue guidance, but they maintained their gross margin target of 32 to 34%.
And they still expect to acquire at least $100 million in annual revenue this year, right?
Exactly. Plus, Q3 interest and amortization expenses are guided to hold steady at roughly $10 million each. So a flawless double beat in a brutal macro environment.
So you deliver all that and your reward, the market immediately hits the sell button.
Yeah, it's the ultimate earnings day paradox.
The shares dropped 2.05% in pre-market trading, falling to $236.56.
And, the bleeding didn't just stop at the opening bell. The stock remained heavily pressured throughout the entire session.
Right. The market looked at this highly profitable, growing business and essentially said, no thanks.
Which is wild.
It is wild.
Yeah.
So that sets up our core mission for this deep dive. We're tearing into the Q2 2026 earnings call, the financial reports, the macro data for IBP. We've got to figure out why Wall Street sold off a stock that delivered such a clear double beat.
Because as retail investors, when you see a divergence this massive between the headline numbers and the stock reaction,
something's wrong.
Yeah, usually means the algorithms and the institutional analysts are seeing something really troubling under the hood.
So to solve that mystery, you basically have to look straight past the revenue and the EPS, right? You have to dig into the profitability metrics.
Specifically, you got to look at the gross margin.
Right.
The consolidated gross margin for the quarter slipped to 33.3%.
Down from 34.2% a year earlier.
Yeah. That is a 90 basis point drop.
I mean, nearly a full percentage point of margin just erased.
Exactly.
And in the financial world, a drop like that doesn't just happen in a vacuum, especially not when your total revenue is actually going up.
No, not at all.
So where is the bleed coming from?
Well, the primary driver behind that margin compression is this really fundamental shift in their product and segment mix.
Okay, break that down for us.
So IBP has their core installation segment. That's their bread and butter, right? But they also have what they call their other segment.
Right, the other segment.
Yeah, which is basically manufacturing and distribution. So think of products like cellulose insulation, which they manufacture and sell into the market themselves.
Okay.
This quarter, that other segment saw just massive explosive growth. It jumped 50% on a reported basis.
Wow, 50%.
Yeah, and 28% on a same branch basis.
I mean, on the surface, 50% growth sounds like a massive win, right? You're bringing more total cash through the door.
It does. It contributes positively to total gross profit dollars? Absolutely. But, and here's the catch-22 that completely spooked the market, that manufacturing and distribution segment operates at a structurally lower margin.
How much lower?
We're talking about a 24.7% margin.
Oh, okay.
Now compare that to their core installation segment, which operates at a much higher 36.5% margin.
Ah, okay. Because installation involves, like, specialized labor and local market capture.
Exactly.
Whereas just manufacturing a product, like cellulose insulation, is highly commoditized. It's way more competitive.
Precisely. You can charge a premium for the actual service of installing the product perfectly on a tight timeline.
Right.
But the physical product itself, there's a hard ceiling on what buyers will pay.
Right.
So because this lower margin business grew so much faster than the core business, it created a massive mix shift.
So the overall consolidated gross margin took a hit just mathematically.
Right, a 40 basis point headwind, simply because a larger slice of their total revenue pie was coming from the less profitable side of the house.
It's kind of like, think of it like a high-end steakhouse, right?
Okay.
And suddenly they start selling a massive volume of low-margin side salads.
Right, right.
The total register receipts for the night, the top-line revenue, it looks fantastic because sheer volume is way up.
Yeah.
But when the accountant runs the numbers at the end of the month, the overall profitability percentage of the restaurant just takes a significant hit.
Because the sales mix shifted away from the premium steaks.
Exactly. But I've got to ask, as an investor looking at this, is the market overreacting? I mean, isn't this essentially just a mathematical quirk of diversification? They're still making more total money, just at a slightly lower average rate.
Well, that's the crucial debate right there. What we're seeing is how the market weighs absolute profit against profit efficiency.
Interesting.
If you're managing your portfolio, you really need to understand this dynamic. Wall Street scrutinizes margin compression relentlessly.
Especially for a stock trading at a premium valuation, right?
Oh, absolutely. When a company is priced for perfection, institutional investors treat any deterioration in margin quality as a massive red flag.
Yeah.
They worry the core business is stalling out.
Yeah, that makes sense.
But to make matters worse, it wasn't just a mix shift causing the pain today.
Right. There were real cost pressures, too.
Very real, tangible cost pressures eating into that core business.
The financial reports highlighted that rising fuel expenses alone shaved 50 basis points off the core installation segment's margin.
50 basis points just from gas.
Right. Because when your business relies on fleets of trucks rolling out to thousands of job sites every single day, fluctuating fuel costs just act as a direct tax on your profitability.
Exactly. And, the pressure didn't stop at the gross margin line either.
Where else?
When you look further down the income statement at SG&A selling, general, and administrative expenses, that crept up slightly to 18.9% of sales.
And what drove that?
Management cited rising medical insurance costs as a primary driver. So when you put all these puzzle pieces together, you've got a product mix shift diluting the gross margin.
Fuel costs eating into the core product margin.
And medical costs inflating the corporate overhead.
It paints a picture of a company fighting a grinding war on, multiple fronts just to maintain its profitability levels.
That's exactly how Wall Street saw it.
Right. And since that core installation margin is clearly the crown jewel of this company, it's sitting at that very healthy 36.5% mark, we really need to examine the specific end markets driving that segment.
We do.
We have to figure out where the actual weakness lies. Because despite the overall company revenue going up, total installation same-branch sales actually declined 2% for the quarter.
Yeah, that's the metric that had analysts really sweating.
So what's dragging it down?
The primary drag on that core segment is coming from new single-family residential construction.
The starter homes.
Yep. Same-branch sales in that specific category fell 6%.
Which perfectly mirrors the broader macro data we saw released in the quarter.
Oh, absolutely.
U.S. Census Bureau data showed a 4% drop in overall single-family starts in Q2.
Yeah.
Management directly cited affordability concerns, which totally makes sense with mortgage rates where they are.
And low consumer confidence.
Right. In fact, they're now projecting these single-family starts to fall mid-single digits for the entire year.
The starter home market is essentially paralyzed right now.
It is. But the data gets incredibly fascinating when you slice it, one layer deeper.
Oh, the public versus private builder dynamic.
Exactly. There's a massive divergence right now between public and private home builders.
Yeah, management specifically noted that private builders are holding up significantly better in this environment.
Right. While the massive publicly traded housing companies, the names you see on the stock exchange, they saw mid-single-digit revenue declines.
And IBP saw their revenue tied to those specific public builders decline by a very similar amount.
So let's explore the mechanics of why that divergence exists. Because usually, we assume the massive public builders have the advantage, right?
You think so?
They have the scale, the access to capital, the ability to buy down mortgage rates for their buyers. So why on earth are private builders outperforming them right now?
It really comes down to the type of homes they build and the demographic they sell to.
Okay, how so?
Public builders focus heavily on volume, right? Spec homes, entry-level, mid-tier communities.
The affordable stuff?
Well, supposedly affordable, but that specific buyer demographic is hypersensitive to mortgage rate shocks.
Right.
If the monthly payment goes up by $300, they're just priced out entirely. They can't buy.
That makes sense.
But private builders, on the other hand, tend to focus more on custom, semi-custom, or premium builds.
Ah, the higher end.
Right. Their buyers often have more equity from previous homes, larger down payments, and they're just significantly less sensitive to macroeconomic headwinds.
So the high-end private market just keeps on building, while the volume-driven public market hits the brakes. But wait, even with private builders holding steady, if residential as a whole is dragging the core segment down 6%, something else had to be doing some serious heavy lifting to keep the total installation decline to just 2%.
Oh, something absolutely was. And that savior was the commercial sector.
The commercial sector.
It single-handedly rescued the quarter. Commercial same-branch sales jumped 10%.
Wow.
Yeah, but the standout performer within that group is what they call heavy commercial, which grew an astonishing 16% on a same-branch basis.
16% organic growth in a high interest rate environment.
Yeah,
That is a massive achievement.
it's phenomenal. And, the most important part is that this isn't some one-off anomaly or like a timing quirk with project completions.
It's a trend.
Definitely.
Yeah.
Heavy commercial just notched its 5th consecutive quarter of double-digit installation sales growth.
5 quarters in a row.
Right. They're putting up record revenue numbers consistently.
Right.
And to top it off, their contract backlog is still growing despite how rapidly they're converting those contracts into revenue.
Okay, but I want to pause here and challenge this broadly bearish housing narrative that the market seems to be reacting to so violently.
Sure, go for it.
Yes, Q2 was a tough quarter for residential. A 6% drop hurts, obviously.
Yeah, it does.
But if you read the transcript of the earnings call, management pointed out that those struggling public builders are actually guiding for sequential improvement in the third and fourth quarters.
Right. They see light at the end of the tunnel.
Exactly. And furthermore, they noted that the multifamily construction backlog, which has been, sluggish for a while, actually started showing real green shoots
It turned positive in June.
and stayed positive through July.
Right.
So if the public builders are explicitly signaling a second half inflection and multifamily is already turning positive, is the market unfairly punishing IBP for a temporary rearview mirror dip in residential?
You're identifying the classic tension of how markets discount the future versus the present. Right now, the market is pricing in the concrete reality of the 6% drop we just witnessed. They aren't placing a premium on the hope of the sequential improvement the builders are promising.
They want to see the receipts first.
Exactly.
Yeah.
Investors want to see the recovery in the hard data before they price it in. But, if we connect this to the overarching strategy of the business, it highlights exactly why structural diversification just saved IBP's quarter.
Because their fate isn't entirely tethered to the single-family starter home anymore.
Exactly. Building out a robust commercial wing acts as a powerful shock absorber when residential construction inevitably hits a cyclical rut.
Right.
Think about where this company was a few years ago. A 6% drop in single-family residential would have been absolutely catastrophic for their top line.
It would have tanked the whole stock.
Oh, completely. But today, because they spent the capital to build out this heavy commercial capability and they expanded their manufacturing and distribution arms.
They can absorb a direct hit to their biggest market.
Yep. Still deliver a 2% overall revenue increase and comfortably beat Wall Street's consensus estimates.
That's resilience. But, survival isn't the same as premium growth.
True.
With organic residential volume clearly struggling in the immediate term, management can't just rely on macro wins to hit their growth targets.
No, they have to pull their own levers to keep investors satisfied.
And based on the sources, they're relying heavily on 2 specific levers right now: aggressive pricing power and highly strategic capital allocation.
Yeah, let's examine that pricing strategy first, because the dynamic here is completely split depending on the specific material you're looking at.
Yeah, it's wild. The pricing narrative is fascinating because it's a tale of 2 entirely different markets.
Right.
Let's look at spray foam insulation first. The manufacturers of spray foam have pushed a hefty 25% price increase onto the market.
A 25% material cost increase.
Yeah, in a housing market where affordability is universally cited as the #1 headwind.
It sounds insane.
It does. How does management possibly expect a hike that massive to stick without customers aggressively pushing back or simply switching to cheaper materials?
Well, it sounds completely counterintuitive until you map out the specific supply chain and the end consumer.
Okay, walk us through it.
Management expects this price hike to stick precisely because of where spray foam is utilized.
Which is where?
It's not going into your standard entry-level spec home.
Ah.
It's heavily utilized in custom and semi-custom homes, the exact segment dominated by those private builders we discussed earlier.
Right, the buyers with the equity.
Exactly. The buyers in that premium segment are prioritizing long-term energy efficiency, structural integrity, premium finishes. They're fundamentally less sensitive to price hikes compared to an entry-level home buyer.
Yeah, I guess adding a few $1,000s in spray foam cost to a $2 million custom build is simply not going to kill the deal.
It's a rounding error for them.
So they possess genuine pricing elasticity, but it's entirely dependent on the wealth demographic of the end consumer they're serving.
Exactly. Even still, though, management did issue a warning.
What was the warning?
They said the third quarter could be bumpy as the market attempts to fully digest that massive 25% hike.
Right, because there's always a lag in market acceptance and negotiations will definitely get tense.
Oh, for sure. But contrast that pricing power with what we're seeing in fiberglass insulation.
Oh, this is the flip side.
Yeah, management noted that fiberglass pricing currently lacks any real traction whatsoever.
Zero pricing power.
None. And the mechanics of why are simple. There's ample supply flooding the market.
And new manufacturing plant capacity is actively coming online, right?
Yep. And when supply heavily outstrips demand, you lose all your pricing power.
Right.
So they have incredible leverage in spray foam, but they're essentially fighting gravity with fiberglass,
So they're fighting gravity with fiberglass and relying on premium spray foam to hold the line on margins.
basically.
But organic pricing power alone isn't going to be enough to appease Wall Street right now.
No, it's not.
If you can't grow your business organically because the macro environment is suppressing volume, what's your only other option?
You got to buy the growth.
You have to buy it, and that explains their aggressive mergers and acquisitions strategy, which management stated flat out is priority number one.
Right.
They've already acquired $59 million in revenue year to date.
And we can see exactly how they're executing this too. If you look at the deals they closed in the second quarter and into July, they acquired companies like Diamond Energy Systems, Hartcraft, and Builders Hardware of South Carolina.
So how exactly does this diversification work in practice? Are they just buying out like mom and pop fiberglass installers to get more trucks on the road?
No. And that's the crucial strategic distinction to understand here. These are classic bolt-on acquisitions,
Meaning what?
meaning they aren't just buying more of the exact same capacity. They're buying adjacent product capabilities.
Huh.
They're acquiring companies that specialize in mechanical insulation for industrial applications or residential add-ons like shower doors, mirrors, and specialty hardware.
Which makes perfect sense from a unit economics perspective.
Totally.
Because if your trucks are already at the residential job site and your crews are already inside the house installing the insulation, you've already paid the customer acquisition cost.
Right. You're already there.
So why not capture more wallet share from that same builder? Sell them the shower doors and the closet shelving while you're standing in the house.
Exactly. It increases the total revenue generated per home without requiring you to go out and win a brand new contract.
That's smart. And they expect this strategy to yield at least $100 million in acquired annual revenue by the end of 2026.
Yeah, that's the target.
But, ambition is one thing, paying for it is another.
Sure.
The real story hidden in these financial reports is that they actually have the dry powder to pull this off. Their balance sheet is an absolute fortress right now.
It really is.
Net debt to adjusted EBITDA, which, for you listening, is basically a measure of how many years it would take a company to pay off its debt using its current operational cash flow, is sitting at a very healthy 1.34x.
Which is well below their stated target of 2.0x.
Right.
Having a ratio of 1.34 in this high interest rate environment gives them a massive competitive advantage.
And they specifically mention they're willing to push that leverage all the way up to 3.0x if the right platform deal comes along.
They have the flexibility to be really aggressive.
Yeah. Plus, they aren't just hoarding cash for acquisitions. They returned value to shareholders by repurchasing $76 million in stock during the quarter.
Yes.
And they bumped their quarterly dividend by over 5% to 39 cents per share.
You see, this is where you see the sophisticated financial engineering behind their corporate strategy.
How so?
Utilizing low leverage to buy up $100 million in revenue is a highly calculated way to paper over the organic volume declines we saw in the single-family residential segment.
Right.
They're essentially deploying their pristine balance sheet to buy market share and buy growth during a housing lull.
It's engineering growth when building it organically is just, too difficult given the macro headwinds.
Exactly.
But for your portfolio, it all comes back to how you evaluate that strategy. So what does this actually mean for you as an investor?
That's the big question.
We have a company that delivered a top and bottom line double beat, a quarter largely saved by commercial strength and aggressive M&A, yet they were punished by Wall Street over margin contraction and residential weakness.
It ultimately comes down to a fundamental question of valuation.
Right. Let's look at the numbers.
Based on the source data we've reviewed, Installed Building Products is currently trading at a PE ratio of 25.33 and a PEG ratio of 3.7.
Okay, if you're looking at a PEG ratio of 3.7, you're looking at a stock trading at a massive premium relative to its near-term earnings growth rate.
Massive.
Generally, a PEG ratio over 1.0 suggests a stock might be overvalued relative to its growth, so 3.7 is incredibly steep.
Precisely. This is a stock priced for absolute Flawless execution.
Right.
It is not priced as a value play or a turnaround story. Investors paying a 25 times earnings multiple expect organic growth and expanding margins, not just engineered growth and margin contraction.
So the ultimate takeaway is a question you have to ask yourself before deciding whether this stock belongs in your portfolio.
What's the question?
If residential housing stays softer for longer than those public builders are hoping, can IBP's heavy commercial strength and their $100 million M&A pipeline alone justify that premium 25 times earnings multiple?
That's the exact tension.
Or is that 90 basis point margin contraction we saw today an early warning sign of a severe multiple compression to come?
It's the classic tension between a fundamentally solid, well-managed company executing a smart diversification playbook and a stock price that simply might not leave any room for error in a tough economy.
And that is exactly why you have to look past the headline beats. You have to understand the mechanics of the margins and the mix shifts. But before we go, here is one final thought to mull over based on everything we've uncovered today.
Okay, hit me.
Management noted they are willing to push their leverage up to that 3.0 threshold to acquire a major platform business, right?
Right.
And right now, heavy commercial is their absolute savior.
Right.
But commercial real estate operates on a massive time lag compared to residential.
Oh, yeah. Usually years behind.
Exactly. So what happens if IBP levers up their pristine balance sheet to buy growth right at the exact moment that the commercial construction pipeline finally cracks under the delayed weight of higher interest rates?
Oof, that would be rough.
You'd suddenly have a company carrying maximum debt facing simultaneous contractions in both residential and commercial end markets.
Yeah, that's a massive risk scenario worth watching closely.
Definitely. We highly recommend you follow the show for daily earnings coverage so you never miss the structural mechanics driving the market. We'll see you tomorrow.